Welcome to the Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to talk about mistakes with 401ks during retirement that can impact your financial situation. And we definitely want you to avoid these mistakes, but these are just some things that come up. So we're going to focus on withdrawal mistakes. So the first one is withdrawing too much too quickly. So we've talked about in the past where we expect you to live to 90, 95 years old. And depending on when you retire, so if you retire early or depending on what age, we need that money to last. And if you do retire early, you're taking money out of your investments. Once again, we want to make sure you're not taking too much out, that you have enough that will last. So when we kind of look at financial planning and retirement planning, we want to make sure, do I have enough, and to make sure that it'll last.
And if you find yourself in this situation and are retiring or contemplating retirement, please feel free to give us a call. We'd love to chat with you. Our number here is 760-692-5700. And if you do take out too much too quickly, one of the things that people fail to plan for is the taxes that comes with that.
Oh, yeah.
And if you take out too much too quickly, you may be bumped into the next tax bracket. So definitely want to consider the taxes when you're taking money out of your retirement account. We
often hear, the 4% rule, or take a certain percentage out. It's really also a question of how much assets do you have, how are your investments working, and how much income can you generate from not only your investments but other sources. So once again, do you have enough to cover, or do you have to take from your investments?
I think it's really important to have a plan in place and not just willy-nilly start pulling money out of your retirement
account.
And
then, things that come up along the way are what we hear over time is, well, I want to help my kids, or they might be going through a life transition themselves.
They want to give money to a charity, which is great, but make sure you have a plan first.
Yes. Or they want to give money to grandkids, or and once again, we're not saying don't do it, but we be mindful of what's the impact, and do you still have enough to cover your life expectancies. Another one is ignoring required minimum distributions.
Yeah, so that is basically the IRS doesn't allow your money to just grow and grow and grow in your accounts. You actually do have to take out a certain amount every year after you turn 73. If you were born before 1951, then age 72, but they keep changing that age.
I know, it's going to be 75.
It's going to be 75 soon. So you do need to take out a certain amount from your IRAs and 401ks after you turn a certain age. And if you do miss it, there's a pretty big penalty involved with so let's just say you were supposed to take out $10,000. The penalty would be whatever the excess that you leave in the account, it's a 25% penalty on that.
And then the other thing to consider, look at, is with the required minimum distributions, do you want to take any qualified charitable distributions?
Yes.
And then making sure the sequence of that is done properly too.
That's a really great tax strategy. So a qualified charitable distribution is a way to benefit a charity, but also to make sure that you take that money out of that account that the IRS requires you to take out. But you do have to take it out first.
Yes.
And send it directly. So you take it out, you tell your custodian, I want to send it directly to the charity, this dollar amount, maybe at the beginning of the year. And then when you get your tax form, your 1099-R, you need to be careful because they don't actually designate on the form.
I was going to say, because that's one of the things, it's you get the whole RMD amount on the 1099-R, but you don't.
You need to make sure
your advisor doesn't know unless you tell them.
You have to tell them, and then they can put QCD on your tax return and then exclude that amount from income, and therefore you've satisfied that requirement, but you won't be paying tax, and the charity gets the money. Yeah. So.
And then another withdrawal mistake is taking early withdrawals without planning. So if you take money out before age 59 and a half and it's a 401k plan.
So maybe you retired early.
Yes, there could be a 10% penalty, plus you have to do federal and state taxes.
And there's actually state penalties in some states. So not only the IRS has a 10% penalty, so you're paying the taxes and you're paying penalties on top of it if you're under 59 and a half. So California's is 2.5. I don't know the other states really.
But there also are some exceptions. I mean, there's the rule of 55, which basically allows you to take money out if you're over the age of 55 and you're no longer employed with your employer and it's still with the 401k plan provider. There are some ways you can take some money out of those accounts.
Yeah, there are actually quite a few, except early distribution penalty exceptions, but it really depends on what sort of account it is. Because so an IRA, for instance, you can take money out of that account if you're under 59 and a half, and the early distribution penalty does apply. For instance, if it's your first time home buyer, or if you are using that money to pay for college. And so there are little nuances with each of those penalties, but like a 401k, you can't take the money early out of a 401k and use it for those other exceptions, but you can in case of a death or a disability. And there are a couple of different options to take that money out early, but you definitely want to inform yourself. And the taxes are still due on the distribution. Yeah. It's just that the penalty doesn't apply.
And then once again, if you are taking money out early, how does that impact your overall plan and future? And do you have enough? So making sure you look at that.
And your income.
Yes.
Because if you take it out early, it adds to your taxable income for the year.
And then lastly, failing to consider a sequence of returns. So basically what that means is if you start taking money out and then there's a big market crash or drop in the investments, then you obviously have less money to work with. And so basically at that point, if you're taking a lump sum or a big amount of money out early and there's a big market change, that affects your future kind of sequence of returns. And so that's definitely something real that we look at. We always make sure, we want to make sure you have enough, but we also want to make sure that, if you can work a little longer potentially, or if you can make a little more money, making sure we have that enough income.
Have a plan.
Exactly. So kind of reiterating, having a plan is important. Everybody's a little different on when they want to retire, how much they need. And we obviously have different investment strategies and income sources that we look at when we look at the plan. So if you'd like to contact us, you can reach us at 760-692-5700. And we appreciate you joining us today. And remember to savvy up. Please stay tuned for important regulatory disclosures.
Savvy Women Wealth Management is an SEC registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.